Today, I want to talk about how time is running out for the shorts. I want to explain how they've brought their margin call and liquidation price lower and lower, making them more and more vulnerable and at risk of being liquidated. I also want to explain how Doug Sifu and Ken Griffin have already been missing margin calls, but have so far been let off the hook from the DTCC. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, Dave Lauer tweeted saying, "I don't know how I've missed this, but apparently for years before the events of January 2021, firms were disregarding or having excess capital charges waived." He said it's no wonder we ended up with undercapitalized brokers who couldn't meet their obligations. He said this is a huge risk and moral hazard, and if it's been happening back since 2020, 2019 and before, what's to say it still isn't happening right now in 2022, 2023 and potentially beyond. Dave Lauer thinks the best way to resolve this problem of consistently letting brokers and market makers off the hook for their margin calls is obviously to margin call them and liquidate them. So this is some publicised research of excess capital premium charges calculated versus what was actually applied, not just in 2021, but in 2020 and 2019 and before. So we know specifically that in 2021, both Instinet and Robinhood had massive margin calls waived from the DTCC. Robinhood had $2.5 billion in margin calls waived to just $20 million. Instinet had $66 billion waived down to just $17 billion. It says the 8 member firms that incurred 90% of these excess capital premium charges differ in their capacity to fund potential capital premium charges. But regardless, given the profile of this subset of member firms, the apparent repeat failure of the excess capital premium charge to deter such firms from accumulating excessive risk, and its failure to encourage them to maintain adequate excess capital buffers is concerning. Of the 277 times these firms received an excess capital premium charge, or of the 277 margin calls, during the period from January 2019 to February 2021, the excess capital premium charge or margin call was either not applied or reduced 63 times. So it's not just that one day in 2021 where margin calls to Robinhood and other firms were waived, it's actually happened on 63 separate occasions. And that's a whopping 63 separate occasions, not just at the start of 2021, but through 2020 and 2019 as well. And that doesn't include all of the additional separate occasions those margin calls would have been waived in the later months of 2021 and 2022, and so far in 2023. It wouldn't surprise me if margin calls have now been waived in the hundreds of times. And it says here, in interviews with committee staff, NSCC officials stated that at least one member firm made a business decision to engage in these risky trading activities that will result in the application of a charge or a margin call because they're either comfortable that the amount of the margin call itself will be manageable or feel confident that it would be likely waived. For instance, consider Robinhood Financial President and Chief Operating Officer's comment, "We are too big for the NSCC to actually shut us down." So these market makers and brokers are actually perfectly happy being margin called because they're happy and they're confident the NSCC and DTCC will waive that margin call. But as Dave Lauer points out, that is a huge risk and a massive moral hazard and should be remedied immediately. And interestingly enough, Bigham's has also done some more digging into investigations against Virtue. You can also currently get a guaranteed free share of Tesla, a $50 cash reward, and up to 15 additional free stocks, which you could always use to buy more shares of AMC, GameStop, or a vape. All you have to do is sign up to Moomoo using the link in the description below and make the required qualifying deposit. Moomoo is free to sign up, it just requires that temporary deposit, and it's a really great way to help support my channel and to help support me as well. And on top of that, Moomoo is very easy to use. They've got tons of technical indicators and advanced charting tools and their own options trading platform. So this here says Virtue's controlling shareholder, Vincent Viola, is abusing his control over Virtue's Up-C corporate structure to expropriate value from Virtue at public stockholders' expense. It says Virtue's board of directors is aware of the issue, but instead of fixing it, the board has actively facilitated Viola's expropriation, and Virtue now refuses to produce documents necessary to investigate the apparent wrongdoing. So Virtue is refusing to provide evidence potentially to the Department of Justice or the SEC or whoever is investigating Vincent Viola. So not only is Virtue having its margin calls waived, but it's also being investigated for stockholder manipulation. And that's why Top Stock Alerts has tweeted saying it's only a matter of time before AMC takes off again. He believes over $5 per share and we get a run up straight to double digits. Now, while you could say this is all trust me bro information, which it is, I do believe it actually has some grounding. This trend line has existed for over a year now, ever since they pushed AMC below $20 per share. Every time AMC pokes up above this trend line, AMC has a massive run up and is all of a sudden manipulated back down. Whether that's due to options being manipulated, whether it's due to some FUD coming out about AMC, or whatever excuse they use this time, every single time AMC has gone past this trend line, it's been very close to the hedgies losing control. Back in March of 2022, we ran from $8 per share, well above $20 per share in just a few trading days. Then again in August of 2022, the same thing happened from just around $8 per share, over $16 per share. And again, just a couple of weeks ago when AMC had its 250 million volume share day, AMC did break through this trend line, but was obviously manipulated back down. Right now, this region is around $5.33 per share. If AMC runs above that figure, the shorts end up in very risky, financially threatening territory. The reason why this trend line has trended downwards and why their margin call and liquidation level has got lower and lower is because they've doubled, tripled, quadrupled and octupled down on their synthetic short position. The more synthetic shorts they have means the less AMC needs to run in terms of price for those liquidations to have effect. Once upon a time, AMC needed to run beyond $12, $15 per share to threaten the shorts. Now that level is just $5 per share. And that is why time is running out for the shorts, because at some point AMC will push above $5 per share easily and convincingly, back above 15, back above 20 and through squeeze territory. And at which point no amount of manipulation will be able to stop the AMC squeeze. And Zero Hedge has also tweeted saying, here comes the next squeeze. Hedge funds are currently shorting ETFs at the fastest pace since September of 2020. That means once again, you guessed it, the shorts have doubled down on their short position, not just by shorting AMC directly or indirectly through total return swaps, but they're also now shorting AMC and GameStop related ETFs. We know, for example, there's a number of different GameStop ETFs that have short interest well above 400%. 400% of the entire ETF is sold short, obviously on a leveraged basis, and that comes from hedge funds. And it seems they're doubling, tripling and quadrupling down on their short positions against these ETFs. They're currently just as short on ETFs as they were back in September 2020. And guess what happened just a few months after September 2020? January 2021. Now the French AMC Ape has also tweeted about what is likely to cause this massive credit event, causing a stock market crash and the AMC squeeze. So Markets and Mayhem tweeted the other day saying a storm is coming in China. The Chinese property market has fallen 82% since its May 2021 peak. Back then, the Chinese real estate total return index was around 400 points. Now it's below 100 points. The French AMC Ape added saying it's a death cross for Chinese real estate, more than an 80% collapse, and it could lead to a real crash. He said Evergrande was the biggest real estate company and hedge funds used its collateral to bet against America, but that will soon be worth nothing. Now Michael Gayed, somebody that's not even related to the AMC, GameStop or Ape movement, has also tweeted saying a stock market crash alert. Could China spark the credit event? So it even seems people completely unrelated to AMC and GameStop are also worried about China triggering this credit event. On top of that, it also seems like analysts and other major banks are already foreseeing this crash. And as a result, they're trying to pump the last they can out of this tech rally. HSBC has increased their price target on Nvidia from $600 per share to $780. Considering Nvidia is trading around $450 per share, that's a ridiculous price target increase. Many in the comments are saying that it's time to exit and that they cannot wait for the dump, and the dump will be amazing. It's likely these hedge funds, institutions and banks are trying to use many unsuspecting retail investors as exit liquidity. trying to pump this stock as much as they possibly can, trying to squeeze out every penny possible until they receive those impending margin calls. Until we get that credit event, the stock market collapse, margin calls left, right and centre, and the squeeze. And finally, Amir has tweeted this meme of Ken Griffin saying, "I just want to tell you from the bottom of my heart, I can't cover." And while I do think this is absolutely true, I think this meme would have been better with Ken Griffin in that House Financial Services Committee investigation interview saying, "Judge, let me be perfectly clear. Can I cover? Absolutely not." We know Ken Griffin and the shorts are stuck in their short positions and cannot escape. We know they've doubled, tripled and quadrupled down on their short positions, bringing that margin call level lower and lower. They've brought it down from $100 per share down to $50, down to $30, down to $20, and now between $5 and say $10 per share. And now the slightest AMC run will trigger a massive cascade of margin calls and liquidations. That is obviously when the DTCC and NSCC finally decide to enforce those margin calls, which they've already waived 63 separate times between 2019 and 2021. And as always, guys, be sure to let me know what you think down in the comments below. And as always, guys, be sure to drop a like down below, subscribe to the channel, and ding that notification bell.